The Federal Reserve just cut rates and headlines are cheering. Mortgage rates are finally slipping, and some people think the housing market is about to roar back to life. But here's the catch. The foundation is already cracked. The three sides that keep housing stable, prices, mortgage rates, and wages, aren't lining up. It's like a triangle that doesn't connect, and when that shape breaks, affordability collapses. Buyers feel squeezed, sellers feel stuck, and the system itself starts to strain. That's the setup we're walking into in 2025. The numbers don't add up, and experts are calling it one of the most dangerous conditions we've seen in years. Let's go back to the broken triangle and look at each side of that triangle. Since before the pandemic, national home prices have climbed by roughly 50%. That means a house that sold for $300,000 in 2019 is now closer to $450,000. At the same time, mortgage rates that hovered near 3% back then are now above 6%. And wages? They've grown too, but only by about 20% in that same stretch. What does that mismatch look like in everyday life? Buyers are being forced to stretch further, either putting down bigger chunks of cash, taking on heavier monthly payments, or downsizing their expectations. Sellers, on the other hand, don't want to slash prices, so many choose not to list at all. And banks are more cautious too because lending into an affordability squeeze carries extra risk. Economists call this a market under stress. Sales volumes hit multi-decade lows, inventory is stuck, and affordability indexes hover near their weakest levels in decades. So it is not just a single problem, but a system where the basic math of housing no longer works the way it used to. If you've heard an older relative say, "It was easier to buy back then," you might roll your eyes. But when you actually look at the numbers, they weren't exaggerating. The difference in affordability between then and now is staggering. If you look at the income chart that has been adjusted for today's dollar, the typical U.S. household earned roughly $64,000 a year in the late 1990s and about $70,000 around 2000. By today, that line sits close to $80,000. Incomes rose, but not explosively. Now look at the house price chart. In the early 1990s, the average U.S. home was about $150,000. By 2000, it was about $212,000. And recently, that average tag is close to $450,000. That slope is a lot steeper than the income line. And if you look at the ratio chart, you can see why it feels harder. The price-to-income multiple stretched from roughly 3.6 times to over 5 times now. Here's what that means in real life, using simple, consistent assumptions. 20% down, 30-year fixed. Back in the 1990s, take that $150,000 home, put 20% down, finance the remaining $120,000 at roughly 7%. The monthly payment pencils out near $800. With a median income around $64,000 adjusted for today's dollar, about $5,333 per month. That's roughly 15% of income. Manageable. Around $2,000. Price $212,000. Same 20% down. Loan $169,600. If you paid about 7.5%, the monthly payment comes to roughly $1,186. With a $70,000 income, about $5,833 per month. That's close to 20% of income. A stretch, but doable. Today, using a $450,000 average price, 20% down leaves a loan of near $360,000. At a 6.3% most recent 30-year rate, the monthly payment comes out to about $2,228. With income around $80,000, about $6,667 per month. That's roughly 33% of income. So, if a family making $6,000 a month after taxes buys the same house with today's prices and rates, their payment would be $2,300 or $2,400. That's almost half their income gone before groceries, cars, or childcare. One more twist. If you look at rents in many metros, the rent check near $2,000 often undercuts the mortgage on the same home at today's prices and rates. Renting used to be the expensive bridge. Now, in many places, it's the cheaper monthly path, at least for the moment. This generational shift matters for more than just dinner table debates. It changes the psychology of the market. If young households don't believe home ownership is realistic, they delay buying. If rents stay high, they delay saving. And if both costs rise faster than wages, you create a cycle where fewer people build equity early in life. That's the affordability cliff we're standing on today. And unless one side of the triangle, prices, rates, or wages, bends back into place, the climb for first-time buyers will keep getting steeper. And that brings us to the Fed's latest move, which some people hope could be the release valve. So let's talk about the Federal Reserve, because this is where a lot of people get confused. Back in September, the Fed made its first rate cut of the year, about 0.25%. That dropped the federal funds target range to roughly 4 to 4.25%. And right away, headlines everywhere shouted, "Mortgage rates are falling." But here's the thing, the Fed doesn't actually set your mortgage rate. What it does is more like changing the speed limit on the economic highway. The Fed can slow things down or let them speed up, but it's not the one holding the steering wheel of your mortgage. The driver of that car is the bond market, specifically the 10-year Treasury yield. Here's why that matters. When banks decide how much to charge you for a 30-year mortgage, they look at what they can earn by lending to the U.S. government for 10 years. That's considered a risk-free loan. To lend to you, they'll always want a little extra, what's called a spread. So if the 10-year yield is at 4.15%, your mortgage rate would be above that, which sits at 6.3% today. After the Fed's September cut, the 10-year yield did dip, sliding closer to 4%. And as a result, mortgage rates moved into the mid-6 range instead of hovering near 7. That shift sounds small, but on a $450,000 loan, it can save you a couple $100s every month. And when millions of buyers feel that at once, demand can snap back almost overnight. But, and this is the catch, it works both ways. If inflation surprises to the upside, or if the job market keeps running hot, bond investors demand more yield, and mortgage rates rise again. So, while the Fed can give the market a nudge, the real story is whether the bond market believes inflation is under control. That's why Buffett keeps hammering on discipline. A quarter-point cut feels good at the moment, but it doesn't fix the broken triangle. It just buys time. Think of it as giving the housing market a sip of water when what it really needs is a full meal. And that brings us to the other side of the equation, inventory. How many homes are actually for sale? Right now, the supply is rising compared to last year, but still sits at only about 4.5 months worth of homes nationwide. To put that in perspective, a healthy market usually needs 6 months of supply. Anything less means sellers have the upper hand and buyers have fewer options. Why is inventory stuck? The answer is what many call the golden handcuffs. Millions of homeowners refinanced or bought homes when mortgage rates were in the 2 and 3% range. Walking away from that deal feels almost impossible. Imagine sitting on a 30-year loan at 3%. If you sell and buy again, you're trading that for 6% or more. Your payment could double for the same house. No wonder people are choosing to stay put. In fact, data shows that more than 60% of current mortgage holders are locked into loans below 4%. That's like having a VIP pass to cheap money, something you don't just give up willingly. And here's the ripple effect. Fewer listings mean less choice for buyers, which keeps prices sticky even when sales slow. Builders can step in with new construction, but they can't build fast enough to replace the millions of homes trapped by those golden handcuffs. Think of it like a concert with thousands of people holding tickets but refusing to leave their seats. Until some of them stand up, no one new can get in. Over time, of course, life happens. People move for jobs, families grow, or retirees downsize. Those changes gradually loosen the handcuffs. But it doesn't happen overnight. For now, this supply freeze is one of the main reasons the warning feels so urgent. Even with softer demand, prices aren't falling the way you'd expect because too few sellers are willing to take the plunge. So if the triangle is broken and inventory is frozen, the big question is, what could actually make homes affordable again? From where we stand in 2025, there are really only 3 doors the housing market can walk through. Door 1, wages rise faster than home prices. This is the healthiest scenario, but also the hardest to pull off. If incomes climb at 5 or 6% a year while home prices stay mostly flat, buyers slowly regain ground. Over a few years, that can shrink the gap between what people earn and what homes cost. The challenge is, wage growth has been closer to 4.8%, while prices, even cooling, are still creeping up by 2 to 3%, 3% to 4%. Progress is slow, and families feel squeezed in the meantime. Door 2. Prices cool off. If home values drop by 10 or 15%, affordability improves quickly, but there's a trade-off. That kind of decline could push recent buyers underwater, owing more than their home is worth. Negative equity creates its own problems: foreclosures, stressed banks, and, in worst cases, recession risk. History shows price corrections usually come with pain. Door 3. Mortgage rates keep falling. This is the option many are hoping for. If the 30-year fix drifts down toward 5.5%, monthly payments drop even if prices don't move much. On a $450,000 loan, that's a savings of $300 to $400 every month. That makes ownership feel realistic again for a lot of households. The danger, of course, is that lower rates can reignite demand and push prices higher, offsetting the benefit. The truth is, the housing market probably won't walk through just one of these doors. It'll brush against all three in some combination. A little wage growth, some softening in prices, and a slow drift down in rates. But the order matters. If wages rise first, affordability heals. If rates drop first, demand could spike before supply loosens. And if prices take the lead downward, the economy feels the shock. And here's where the Fed comes back in. The more aggressively they cut, the more likely door 3 opens first, which is exactly what we're starting to see in the latest demand numbers. We don't have to guess how the market reacts when rates move, because we're already seeing it happen. As soon as mortgage rates slipped into the mid-6s after the Fed's September cut, buyer activity picked up almost instantly. Pending home sales, which track contracts signed but not yet closed, jumped several percentage points in just a single month. That's proof that demand isn't gone. It's just been waiting on the sidelines for a chance to re-enter. New home sales told a similar story. Builders, who've been offering rate buydowns and incentives all year, suddenly saw traffic surge. Annualized sales pushed close to 800,000, the highest pace in months. For a sector that looked shaky earlier in the year, this bounce shows how sensitive buyers are to even small shifts in affordability. But here's the part that keeps pressure on the system. Housing starts actually fell in August. Builders are selling what they already have in the pipeline, but they're cautious about starting too many new projects. With labor shortages, material costs, and lingering uncertainty about rates, they're not rushing to flood the market with new supply. This creates a tug of war. On one side, lower rates wake up buyers. On the other hand, limited supply keeps prices from cooling much. It's like opening more lanes on the highway, but leaving the same number of cars on the road. The traffic flows faster, but it doesn't really get less crowded. And this is where Buffett's warning comes back into focus. If affordability depends on both demand and supply, then the next move isn't just about interest rates. It's about how much inventory actually comes online. And to understand how tricky that balance is, it helps to look at why Buffett himself has always said real estate is tougher than stocks. Buffett's lens. Why housing is tricky and where he's focused. Whenever Warren Buffett talks about real estate, he usually adds one important disclaimer. It's tougher than stocks. Why? Because real estate deals are slow, messy, and filled with moving parts. You need buyers, sellers, brokers, appraisers, inspectors, banks, and sometimes even city councils just to get one deal done. Compare that to stocks. You click a button, and you own a piece of Apple or Coca-Cola. Buffett has never been against housing. In fact, Berkshire Hathaway owns Clayton Homes, the largest builder of manufactured and modular housing in the United States. Berkshire also controls Home Services of America, which operates the Berkshire Hathaway Home Services brokerage network, one of the biggest real estate brokerages in the country. Instead of short-term speculation, both businesses are structured around providing housing, financing, and related services at scale, aiming to capture long-term customers and recurring revenue streams. The IDEA is simple. Real estate is a patience game. It doesn't reward people who try to get rich quick. It rewards people who buy with a margin of safety and hold through cycles. That's exactly why Buffett has been stressing affordability. If the math doesn't work for buyers today, the market won't stay balanced tomorrow. And with that perspective in mind, let's talk about what it means if you are planning to buy a home in the next 6 to 12 months. If you're thinking about buying a home in the next 6 to 12 months, the first step is to forget about timing the market perfectly. Even Buffett says he doesn't know exactly where prices or rates will be next quarter. What he focuses on instead is margin of safety, making sure the numbers work even if conditions don't improve right away. So, how do you apply that? Start by running your affordability test at today's mortgage rates, not the dream rate you hope for later. If the average 30-year fixed is sitting around 6.3%, use that as your baseline. Then ask yourself, if rates drop by just half a point, could I still comfortably afford this house? If the answer is no, you're probably stretching too far. Next, look for opportunities where sellers or builders are offering incentives. Many builders right now are buying down rates for the first 2 or 3 years, or they're throwing in closing cost credits. Those temporary perks can bridge the gap while you wait for rates to drift lower. Also, don't ignore the strength of pre-approval. Having your financing lined up not only locks in today's rate, but also makes you a stronger buyer when competition heats up. Think of it as being first in line at the checkout counter when everyone else is still deciding what to buy. Finally, remember Buffett's core principle. Don't swing at every pitch. You don't have to buy just because rates tick down. The best move is to focus on a home that fits your life and your budget, not just the headlines. If you can do that, you'll put yourself in a position where any future rate cuts or wage gains are a bonus, not a requirement. If you're on the selling side in 2025, the landscape looks very different from just a few years ago. Back then, homes were getting multiple offers within days. Today, buyers are more cautious and affordability is tighter, which means you have to approach your listing with a strategy. First, understand where demand is strongest. Mid-priced homes, the ones that fit average incomes, are moving faster than luxury listings. If your house is in that sweet spot, you'll see more activity. High-end properties, on the other hand, are sitting longer because fewer buyers can stretch for them at today's rates. Second, be realistic with pricing. Don't anchor yourself to the peak numbers from 2021 or even early 2022. Price where the buyers are today, not where you wish they were. The homes that sell are the ones that meet the market, not fight it. Finally, think creatively about concessions, covering closing costs, offering credits for repairs, or even helping with a rate buy-down can make your home stand out without requiring a huge headline price cut. In a market this competitive, small gestures can tip the balance in your favor. Now, from the investor's perspective, because Buffett's warning matters just as much here, his philosophy has always been simple. Don't fight the system, ride the tide. In real estate, that means you don't try to outsmart interest rates or guess where prices will be next month. Instead, you buy properties that make sense at today's numbers, and you let time do the heavy lifting. Here's how that looks in practice. Start by underwriting deals with current mortgage rates, not the ones you're hoping for. If the average 30-year fixed is 6.3%, plug that into your math. If the deal only works at 5%, it's not really a deal. It's a gamble. Next, focus on markets with durable rent demand. Think job growth, universities, medical hubs, or regions where new construction is limited. Buffett invests in companies with predictable cash flow. Real estate investors should look for the same thing in rental income. And don't forget refinancing optionality. If you can lock in positive cash flow now, any future drop in rates is upside. That's the Buffett way. Treat good news as a bonus, not a requirement. For example, an investor who buys a duplex today in a growing college town might lock in break-even or slightly positive cash flow. That same property, refinanced a year or two down the road, could suddenly generate hundreds more in monthly profit. The disciplined investor builds in that margin now instead of hoping conditions magically improve later. Finally, be patient. Buffett often says opportunities don't come every day, but when they do, you have to be ready. In housing, that might mean holding cash until you see a deal where the math lines up. The point isn't to swing at every pitch, it's to wait for the fat pitch that you know you can hit. So, let's bring this full circle. The warning for the housing market isn't about one single number, it's about the bigger picture. The triangle is broken, prices are too high, wages haven't caught up, and rates, even though they've dipped, are still heavy. That combination makes affordability the tightest it's been in decades. The Fed's recent cut gave the market a jolt, and mortgage rates have eased a little. But as we've seen, that alone doesn't fix the imbalance. It may even spark more demand before supply has a chance to adjust. The real story is whether wages grow, prices soften, or rates continue to drift lower, and which door opens first. For buyers, it means patience and discipline. For sellers, it means realistic pricing and creative concessions. And for investors, it means positioning yourself to benefit, no matter which way the tide flows. Buffett's core advice applies perfectly here. Don't swing at every pitch. The opportunities will come, but you need to be ready. The stock market recently hit record highs, but can it really stay there? Click the video on screen to find out.